Welcome back to The Breakdown with me, NLW. It's a daily podcast on macro, Bitcoin, and the big picture power shifts remaking our world.
What's going on, guys? It is Sunday, January 19th, and that means it's time for Long Read Sunday. Before we get into that, however, if you are enjoying The Breakdown, please go subscribe to it, give it a rating, give it a review, or if you want to dive deeper into the conversation, come join us on the Breakers Discord. You can find a link in the show notes or go to bit.ly/breakdownpod. All right, friends, back with another Long Read Sunday. Big theme right now, maybe the biggest theme in crypto, is the transition from the hype and excitement around the presidential transition to the figuring out what real is actually going to happen. Along those lines, a group of 20 lawyers in the crypto space have written an opinion piece called How to Make the United States the Crypto Capital of the World. This is exactly the sort of very practical, tangible advice and policy making that I think we are going to be looking forward to now. And so let's read what they have to say. I'll turn it over to AI to read this for you. So, of course, apologies for any weird pronunciations or affectations. And then I'll come back and discuss what I think about this piece. Again, this is called How to Make the United States the Crypto Capital of the World, and it's by Ivo Enchev, Olta Andoni, Stephen Rutenberg, Donna Rettel, and signed by another 20 lawyers or so. How to Make the United States the Crypto Capital of the World. Dear President-elect Trump, in your keynote address at the Bitcoin conference in Nashville last year, you pledged to make the United States the crypto capital of the world if re-elected for a second term. As you return to the presidential office this Monday, we write to you as practicing members of the crypto law bar to recommend regulatory policies that will help you to achieve that goal. The United States, which rests on the same foundation of personal liberty as crypto, is naturally positioned to lead the world in its development. Unfortunately, U.S. regulators have until now refused to adapt existing laws to digital assets and the blockchains that underpin them, or even to explain why not, and created an unfavorable business environment that has driven many entrepreneurs and developers abroad. To unleash American ingenuity and remedy this neglect of the blockchain industry, we propose that you pursue the below forward-looking policies across 3 areas: supporting U.S. companies, promoting crypto values such as privacy, disintermediation, and decentralization, and cultivating a favorable business environment domestically, supporting U.S.-based businesses. The crypto industry has produced a range of established and emerging use cases, including digital gold, stablecoins, permissionless payments, decentralized finance, real-world assets, decentralized physical infrastructure, DeFi, and many more. Many of them are being responsibly advanced in the United States by businesses such as Coinbase, Circle, and Consensus, and by developers contributing to crypto's open-source, decentralized infrastructure. To continue competing against their international rivals, these parties need clear rules of the road and proper regulatory guidance. General rules of the road. Token issuance and secondary sales, which lie at the heart of the crypto economy, are subject to confusing and overlapping regulatory authority from the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC. Market structure legislation should clearly delineate the scope of jurisdiction among primary regulators and lay out when assets enter and exit that jurisdiction. Here, Congress should resist giving the U.S. securities laws an overbroad application, as the SEC has done. Tokens powered by open-source software and consensus mechanisms that are otherwise minimally dependent on centralized actors are not securities because there is no legal relationship between token owners and an issuer as understood by the securities laws. Similarly, crypto assets such as art NFTs, which are simply digital artwork, and non-investment activities like staking and lending Bitcoin fall outside the securities laws. Congress should be bold. That means not feeling bound by prior legislative efforts like FIT 21 that were forged in an earlier political environment that have unintended consequences. It also means leveraging the regulatory experience of other nations, such as the European Union with its MiCA framework, while avoiding their pitfalls and charting a unique and dauntless path forward for the United States. Specific sectors. Besides advocating for general rules, your administration should urge Congress and the relevant agencies to address specific sectors due to their strategic importance to the crypto industry and the nation. Stablecoins. Stablecoins, with a current market cap in excess of $200 billion, are the lifeblood of the digital asset ecosystem. Increasingly recognized under frameworks like the stablecoin standard and by state regulators, they warrant comprehensive legislation for their issuance and management, ensuring that they are transparently backed and do not threaten financial stability. Aside from benefiting consumers, regulatory support of stablecoins furthers national interests. Similar to Eurodollars, stablecoins, which are usually denominated in US dollars, reinforce the dollar's status as the global reserve currency and increase demand for US treasuries, which issuers hold in reserve. TradFi integration. The unprecedented success of Bitcoin and Ethereum ETFs demonstrates that crypto has begun integrating with traditional finance. Regulatory policy should ensure a safe and orderly integration by giving consumers access to trusted custody services. This requires amending or rescinding prejudicial SEC accounting guidelines. for instance, SAB 121 and custody rules. But it should not stop there. Pro-innovation policy in this area should also promote the tokenization of securities representing traditional financial assets like stocks, bonds, or real estate as blockchain-based tokens. The resulting benefits, which include improved liquidity, fractional ownership, and faster settlement, would strengthen U.S. capital markets, ensuring they remain the most developed and innovative in the world.
If you've been around Bitcoin for long enough, you've heard the term HODL and the name Ledn. Ledn has been the go-to leader in Bitcoin lending for over 6 years. They help clients unlock the liquidity of their Bitcoin, allowing them to HODL while still accessing the wealth of their BTC. They've been battle-tested with their focus on transparency, security, and trust, allowing them to build a proven track record of client success and security. Ledn has helped tens of thousands of clients harness the value of their digital assets, issuing more than $6.5 billion in loans over the years. But as the crypto industry says, don't trust, verify. Check out Ledn's Trustpilot or their reviews on social media. And to learn more about what your Bitcoin can do for you, check out ledn.io/borrowing. That's ledn.io/borrowing. Please visit ledn.io/legal for product terms and disclosures. Product availability varies by jurisdiction.
DeFi, decentralized finance, has the potential to modernize the global financial system and to return value to ordinary Americans by removing costly financial intermediaries. You should not allow entrenched interest and alarmism to stop the United States from becoming the world's leader in DeFi. In this regard, regulations aimed at centralized actors, such as exchanges and issuers, must be crafted in ways that avoid inadvertently capturing and paralyzing the still nascent DeFi ecosystem. Fostering innovation through a commitment to crypto values. If it is to promote crypto innovation, regulatory policy must show respect for crypto values, including privacy, disintermediation, and decentralization. 2 key regulatory principles arise from this commitment. First, regulation should not impose greater burdens on crypto where traditional analogs exist. Second, regulation should evolve where traditional analogs are absent, when to treat crypto the same as traditional assets and tools. The first principle impacts products like self-custody wallets, which enable users to hold and manage their own private keys. Because these tools are analogous to physical wallets used for personal asset management, they should not be treated any differently, namely as financial intermediaries for purposes of regulatory surveillance and monitoring. You are not required to complete KYC before you can place cash in a physical wallet. The same should be true for storing tokens in your digital wallet. Similar logic applies to the taxation of block rewards. Americans mining or validating blockchain transactions are creating new property, just like farmers growing crops in their fields. And yet the IRS currently taxes them on that income. This differential treatment should be abolished. When to treat crypto differently. The second principle demands regulators resist placing crypto actors and activities into legacy frameworks that are incompatible with crypto. Doing so damages the crypto ecosystem, pushes the industry abroad, and erodes the rule of law. Regrettably, this is the path that many U.S. regulators have chosen. The IRS has begun treating crypto front ends as brokers absent statutory authority. The Department of Justice has begun charging non-custodial wallet developers with unlicensed money transmission violations despite its long-standing policy to the contrary, and the U.S. Treasury has sanctioned the smart contract of privacy mixer Tornado Cash, even though it is neither a foreign person nor property, but merely code. An appellate court overturned the sanction. Without diminishing the importance of the governmental interests at play, tax evasion, money laundering, and national security, we submit that the government's approaches in each case are wrong as a matter of innovation policy, and we encourage your administration to reverse them. Instead of regulating digital asset and blockchain businesses like traditional companies, we urge regulators to collaborate with this new technological paradigm and with our industry. For example, if government surveillance, KYC, in a decentralized environment is actually justified in certain instances, regulators can leverage blockchain-based credentials that are portable across protocols, give users control of their data, a benefit of Web3 architecture, and are aligned with the frictionless blockchain ecosystem. Similarly, they can marshal the programmability of tokens and smart contracts to exclude sanctioned parties from parts of the crypto economy, attracting top talent with a welcoming business environment. To become the leading destination for top crypto talent, the U.S. must cultivate a favorable business environment. Your administration can begin this process on day 1. End debanking of crypto companies. Your administration should direct the FDIC and all other agencies involved with Operation Chokepoint 2.0 to immediately cease their unaccountable campaign aimed at debanking the crypto industry. Improve SEC rulemaking and enforcement. You should instruct your SEC chair to overhaul that agency's approach to crypto. Over the past 4 years, the SEC has consistently exceeded its authority by pursuing good faith industry leaders such as Coinbase and Consensus, regulating individual developers and users in its exchange redefinition rulemaking, and launching enforcement actions against wallet providers. It is time for the SEC to correct this pernicious approach and begin engaging constructively with the crypto industry, while focusing its efforts on preventing fraud rather than curbing financial speculation. which has benefits for innovation. Roll back punitive tax rules. Your administration should roll back punitive tax rules that push entrepreneurs and developers abroad while leaving well-meaning taxpayers uncertain about how to calculate their tax bills. Low-hanging fruit improvements include the adoption of current expensing for software development, tax deferral for validation rewards and airdrops, a safe harbor for de minimis consumptive transactions, for example, less than $5,000, a mark-to-market election for crypto investors, and a repeal of IRS reporting regulations that treat websites as brokers. Congress should also repeal amendments to Section 6050I, which impose burdensome and likely unconstitutional reporting requirements on crypto transactions over $10,000. Reduce unnecessary red tape. Consistent with the mission of the Department of Government Efficiency, DOGE, we urge your office to work with Congress and government agencies to reduce the unnecessary red tape restraining crypto and fintech. This includes simplifying or eliminating registration and reporting requirements for digital asset offerings that meet certain conditions, including providing essential investor disclosures. Congress should also consider legislating a unified federal framework for money transmission licensing that would bring clarity and efficiency to the broader fintech ecosystem. Asterisk, asterisk, asterisk. In pursuing the above forward-looking policies, we encourage your administration to consult with industry leaders and remain sensitive to the transnational scope of the digital asset ecosystem. We view your formation of a crypto council as a positive step in this direction. We also recommend leveraging devices, such as regulatory sandboxes, that limit the risk of unintended regulatory consequences. The time is ripe for the United States to begin asserting its global regulatory leadership. By ensuring that it does, your administration will be contributing to the country's future economic prosperity and endorsing a technology that rests on deeply held American values and freedoms. You should seize the moment. Sincerely, Ivo Enchev, Olta Andoni, Steven Rutenberg, Donna Reddle. The following members of the Crypto Law Bar also signed this letter: Mike Bacina, Joe Carlasare, Eli Cohen, Mike Frisch, Jason Gottlieb, Eric Hess, Catherine Kirkpatrick, Dan McAvoy, John McCarthy, Margaret Rosenfeld, Gabriel Shapiro, Ben Snipes, Noah Spalding, Andrea Tinianau, Jenny Vitrenko, Colin Woodward, and Raphael Jacobi.
All right, back to the real NLW here. One of the most bullish things about this is that lots of it is so obvious and not all that difficult. Ending debanking for crypto companies, rolling back punitive rules, improving the SEC rulemaking and enforcement. All of these things can make a huge difference right away, and many of them simply take a new set of actors not acting like the old type. I love that they get into some of the specifics around when to treat crypto the same as traditional assets versus when to create it differently. But to me, ultimately, the central big question is going to be, as it always has been, this question of what the hell a token is. Is it a commodity? Is it a security? Is it something else? And the reason that this is so important is not just so token issuers can make a bunch of money. It's that the answer to those questions, the specific answers, are going to shape everything about what crypto entrepreneurs can and can't do here in the US. A thesis that I thought was very compelling for a lot of 2023 and 2024, I think I heard Travis Kling maybe first articulate. And that was basically that in the United States, we had largely run up against the limits of what crypto could do in its state of limbo. And that the real unlock and opportunity was allowing crypto to actually be this security-like thing. That doesn't mean unfettered allowing it to do whatever it wants. That just means finding the right structure and bring innovation to the financial sector. It's an ambitious goal when there's so much common rules of the road that need to get built. But I think one of the biggest tells for where crypto ends up in the United States is how we answer that age-old question of what the hell a token is. For now, though, that is going to do it for today's breakdown. Appreciate you listening as always. Until next time, be safe and take care of each other.